Should you subscribe to Indian Railway Finance Corporation IPO? Today we are analyzing the pros and cons of IRFC, the dedicated financing arm of Indian Railways, which opens for subscription today. With the equity market overheated with many stocks now trading at full or stretched valuation, will it be correct move to subscribe into IRFC IPO? Well, the issue consists of offer for sale from the Government of India amounting to Rs 1544 crore and fresh capital raise of around 3089 crore. Why subscribe to IRFC IPO? IRFC is an arranger of finance for railways and its fortune is linked to the Indian government spending on railways, which is likely to continue on an escalated trajectory as railways play a key role in country's social and economic development. Plus, India is on a path of modernizing its railways with extensive work on new metro rail projects and bullet trains about to be taken up in the next couple of years. Most importantly, it raises around 25 to 35% of the total planned outlay of the Ministry of Railways, and its dominant status is expected to be maintained in the coming days. So, IRFC not only offers margin of safety but also provides a good growth opportunity. Business model. So here's what you should know about the functioning of the non-bank infrastructure finance company before investing. At the beginning of each fiscal year, Railway notifies IRFC of its financing requirements that are to be met through market borrowings. IRFC specifically raised resources from the capital market to finance rolling stock, wagons and coaches. In FY20, 76% of Indian Railways' total rolling stock was financed by IRFC. It leases rolling stock to Indian Railways and collects lease rentals from IR in advance at half-yearly intervals. The lease is for a period of 30 years, comprising primary lease period of 15 years, followed by a secondary lease period of another 15 years. IRFC operates on a cost-plus based model, whereby it on-lends to the Ministry of Railways at a fixed margin around 30 to 35 to 50 basis points over its weighted average cost of borrowings. This margin is in accordance with the terms of the standard lease agreement signed by the company with the railways at the end of every fiscal, which was 40 basis points in FY20. In addition to financing of rolling stock assets, it also leases other railway infrastructure assets and lends to other entities under Ministry of Railways, that is Rail Vikas Nigam Limited and IRCON. How IRFC raises funds? Well, the company raises funds at a competitive rate from a diverse pool of that including banks, mutual funds, pension and gratuity funds, insurance companies as well as external commercial borrowings. In addition, it has the approval of the government to issue low-cost capital gains bonds under Section 54EC. IRFC's liquidity profile and asset quality. On the back of sovereign ownership and support from the government in the form of regular equity infusions and favorable lease agreement, the company's liquidity profile remains comfortable. The government has been infusing equity capital at regular intervals to support the capital structure. Rupees 2,854 crore and Rupees 2,500 crore infused in FY19 and FY20 respectively. IRFC's gross non-performing assets was nil on September end on account of its full exposure to the Ministry of Railways or its controlled entities and the timely recovery of receivables. The company does not have to comply with RBI's regulatory requirements on asset classification, income recognition, provisioning and prudential exposure norms due to the extent of its exposure to the Ministry of Railways. Profitability. In FY20, IRFC's profitability improved with return on assets and return on equity increasing to 1.3% and 12% respectively, aided by nil taxes. IRFC's low operating expenses owing to the wholesale nature of the business as well as negligible credit cost due to the superior asset quality supports profitability. The favorable lease agreement with the Ministry of Railways protects IRFC's net interest margin against any exchange rate volatility, interest rate fluctuations, and liquidity risk. Valuation and outlook. At the upper end of the price band of Rs 26, and the issue is priced at 1 time FY20 book value and 0.9 times expected book value of FY22, which is reasonable considering IRFC's parentage and strong financials. But there is always a risk of any adverse determination of margin which can hit profitability.